My name is Bill Lang, and on behalf of Small Business Australia and Business Advantage, I'd like to welcome you to our June 2022 webinar. It's a pretty important topic, EOFY, end of financial year. There are a number of opportunities for many small business owners to take advantage of in coming weeks, and that they will also benefit from post 30 June 2022. Some of you may have already heard that this morning Fair Work Australia has made the decision to increase the basic wage by 5.2%, reflecting effectively the most recent inflation number. But in addition to that increase in wages, of course, we're facing a number of different headwinds as it relates to issues with attracting new employees, getting employees trained and employed, other supply chain related issues, and the growing costs of doing business with everything from input prices for things like energy through to a whole range of other supplies that are used within businesses of all shapes and sizes. Before I introduce our panel today, I'd also like to thank the members of Team Small Business Australia, being National Australia Bank, Telstra, Australia Post, PEXA, and Snap Design and Printing. I would like to thank them for their ongoing support and communication of our buy local movement and the opportunity now for all Australian small businesses to get a free listing at buylocal.smallbusinessaustralia.org. So if you haven't done it yet, please get your business listed. It'll help you with any search engine optimization, be more easily found via Google searches, as well as the many, many hundreds of thousands of Australians that are looking for local businesses to do business with. So as I said, it's a challenging time. We've got a couple of weeks to go until tax time. Many of you already have accountants. Perhaps you have a bookkeeper helping you on that side of things. And what you'll learn today are some key topics and questions to raise with your accountants and your bookkeeper. In addition, for those of you that have recently hired new employees or are looking to potentially hire some in the next couple of weeks, there remains significant opportunities to potentially access up to $30,000 towards the cost of employing and training those new employees. And they may be people that have been employed in the last couple of months, all the way through to those that you might employ in the next couple of weeks. And we'll have Lockie from Grant Help tell us more about that. So we've got Lachlan. He'll be speaking towards the end of the webinar. He's from Grant Help. He's a founder of Grant Help and a director. He was only just telling us that in the last 60 days, he's helped small businesses in Australia access almost $20 million worth of wage support to subsidise the cost of employing and training new employees. Silvano is from the Solutions 2 group. Now, he is a tax strategist and senior advisor. He's going to be talking particularly around the importance of business structures. Now, we all have business structures, but there are a number of opportunities to review what we've got in place and potentially optimize and improve in a very legal way the amount of tax and when we pay tax, not to mention other key factors that are important around liability. Tanya Cunningham is from the Solutions 2 group and Solutions 2 Wealth Management. Superannuation, the contributions that you can make, key sort of areas of sort of tax deductions or tax deductibles, Tanya will be taking us through. And at the end of the webinar, again, I will be moderating the questions and getting them out to everyone that's on the panel, and then letting you know about our next upcoming webinar, as well as the additional services that our Business Advantage members can take advantage inside businessadvantage.online.
Welcome, everyone. I'm quite excited about sharing year-end tax planning with you. This time of year, well, between the months of April, May and June, we find that an important time of the year where we get in touch with our clients. And we see this as a form of business health check, where we review, as part of the year-end tax planning, we review your business performance, your cash flow position, general compliance, where we look at where you're at with your taxes, employer obligations, such as superannuation, payroll tax. We also look at an area which you may be familiar with in a company, directors' loans, the importance of determining profit distribution before 30 June, which is a prerequisite. We also, in that process of tax planning year end, We can identify issues and discuss those issues and concerns with you. We can assist you with making investments in that process and/or borrowing. So ultimately, it's a process of reviewing, planning, compliance, business performance, and estimating taxation outcomes. You may be familiar with business structures, and the common structures we have that you may be familiar with are companies and trusts. I'll talk to you a little bit about companies and some of the features. Some of the features provide benefits, and there are limitations within both structures. In a company, we've got a concept called limited liability. That's the big one in a company, where a company is a separate legal entity from the shareholder directors, and that provides legal protection to the directors, shareholders, providing the directors are complying with their director duties. So very important that we avoid reckless trading, otherwise we fall foul of the insolvency provisions, and that's where directors can be exposed and expose their personal assets. The structure is more suitable for future growth, where we can potentially introduce investors and hence bring in some new working capital. So that provides for growth. It's a effective tax environment. We've seen the tax rate come down from 30 cents and it's currently 25 cents in a dollar, which is a pretty good tax rate. It's got a clearly defined corporate governance process in that it operates within its own constitution. The Corporations Act is also there in place to oversee it. And there are shareholder agreements also to regulate management. We can incentivize employees through a company structure, which assists in retaining key employees. The availability of government grants, but I'll let Lockie explain and talk to you about those a little bit further down the seminar. And a company's got very much a commercial look about it in the public domain. The other structure, which you may be familiar with, is the common family trust, suitable for a small family business, a mum and dad type business, where we've had the opportunity to split income, which has been very attractive amongst family members. However, of late, the trusts have come under attack by the ATO under Section 100A. Now, you may have read about this in the press, or you may have heard it by your accountant. So we need to be very careful when we're considering distributing to adult beneficiaries that we adhere to strict conditions. There's still a place for a family trust in that it's a tax-effective investment environment where we can hold assets. And with that comes a very attractive CGT concession, which is the 50% CGT concession that flows on the capital gain that we make on the sale of an asset. Unlike a company does not attract that 50% CGT discount. It offers asset protection, where the assets in the individuals who operate and control the trust, their assets are protected, and so are the assets in the family trust from outsiders or from any potential claims. Again, of course, within the trust, if we're breaking the rules, then we expose the assets of the individuals as well as the trusts in some cases. There are limitations in a trust, and I'm alluding to some of the grants that are available out there to a company, but again, I'll let Lockie explain and talk to you about those. There is an opportunity to restructure your current structure. Perhaps you've outgrown your business structure and you feel, well, I need to introduce some investors or capital. So there is a way of rolling over your individual sole trader business or family trust, should it be a trust, into a company. There is an opportunity to restructure where we disregard any capital gain arising on that restructure and rolling ourselves into a company, and hence then getting all the benefits of a company, that is the tax rate, the 25 cents in the dollar, the grants, and the opportunity to grow by introducing the potential key employees that we want to retain, or investors by bringing in capital. So that's an important feature in our tax legislation, that we're able to restructure without too much tax consequences as a result of carefully and of course there's got to be commercial reasons for the restructure. That's very important, that we don't just simply do it for tax and tax alone. Some tips and some handy measures before 30 June, and under the government pandemic recovery plan, we introduced the instant asset write-off, and that over time went from a $30,000 capital asset write-off within the year. It grew to $150,000, and then they've now bolstered it where there's no limit on the capital purchase. So that's very handy. We've had clients who have invested in capital assets where that has led to a loss. And as a result of the loss, not only do we get the tax benefit, if we talk about a 25 cents tax rate, if we've invested $100,000 in equipment and we get and we write the $100,000 off, we immediately pick up $25,000 as a tax offset, if you like, or it's a real cash tax benefit. And further, that investment may have led to a loss, and we've got now under the loss carryback tax offset the opportunity to go back into 2 prior years and recover the tax that we've paid on those profits as a result of the loss that we're about to recoup. So that leads to a further recovery of cash, tax offset, if you like, which further improves the investment in the capital asset. So that's a big win. And the instant asset write-off and the loss carryback tax offset work very well hand in hand. Look, another measure that we could apply as part of year end, we could review any income that we may have received in advance. And there's a case called the Arthur Murray case. And that was a dance school that set the precedent that any students were paying their lessons in advance and paying for multiple lessons at the one time. These lessons may straddle over into the following year, and that income that you've received, given that the service has not been delivered, or the dance lessons, the income is not derived for income tax purposes, and therefore is not taxable. So we can adjust for that type of income. I mean, we can apply that to other types of contract income, such as subscriptions, workshops, seminars, We could look at sales in our business and works in progress, and we could choose to defer some of those sales by not invoicing and delaying the invoicing. Do note that it does have a cash flow impact by delaying these sales. So that's a consideration. And at the same time, through this whole process of trying to reduce taxable income, we've got to be aware that we don't overtax plan at the same time. We can also look in other measures. We could look at a common one is accruing an expense in a company or a trust, where we physically don't make the payment, but we just we make a provision for an expense. And down at the individual level, the director, perhaps if it's a director's fee, the director or individual taxpayers are assessed on a cash basis. So there's a bit of a timing issue here where the structure, the business will get an outright tax deduction. However, the individual is not going to be taxed on that income, until the following year. So there's a nice timing that we can defer some tax. Eventually, yes, we need to pay the tax on that provision, but we get the timing break. We can postpone the realisation of an asset. We may have some real estate that we're considering to sell, and that's another opportunity to consider. Again, looking at the overall position of your business, is that something we need to consider, that we can hold off on? Remember that with the sale of an asset, it's the date that we sign the contract, and that's the date of the event, and not settlement dates. That's important. I find that clients can be a little bit confused about that. They feel that it's settlement date, but the horse is already bolted because they've signed the contract and the contract's pre-30 June. Within that postponing of an asset, remember that the asset may attract a 50% discount within a trust. So there's further opportunities within a trust, but I won't talk, that we're able to reduce that capital gain even further if we were running a revenue loss, where we can apply the revenue loss against the capital gain. Unlike if we had a capital loss, we're not able to use that capital loss against our revenue business trading profits. So there's an opportunity there, but careful planning and timing is critical. And lastly, we've got stock revaluation options. Again, the opportunity to value our stock at a lower cost and adopt a lower cost valuation, whether that be on a cost basis or a market value or a selling or a replacement value basis. So look, there's a whole range of things that we can do to carefully look at ourselves, look at our business, and prepare for year end. That gives us generally, peace of mind and avoids the unnecessary nasties that you can face without proper careful planning.
Hi everyone. So I'm here to talk about everyone's favourite topic, superannuation. So not convinced yet. I just want to make a couple of points and reiterate to everyone that superannuation is just another legal structure. You manage how the money in that structure is invested. So my point is, don't be afraid of super. You need to just get involved, get active. If you're a property guru, set up a self-managed super fund, buy your property in this tax structure. So Superannuation is taxed at an amazing 15% tax rate through accumulation phase. And then if you're like Bill and I and getting close to the hairy end of retirement, 0% in retirement. You really can't get better than that. So what do you do to get this amazing deduction? You transfer your money from your personal account into super, from your business account into super. Wait till you're 65, take it out tax-free. So you really can't get better than that. That's all I'm saying. Don't be afraid of it. Get active in controlling how that money is invested inside that structure. So if you're in your industry fund, log in, find out what that investment option is. If you're worried about the volatility of the market at the moment, and you probably should be, before you make the tax deduction, the super contribution this year, log in, turn on the option to say, invest my new contributions in cash. Get active. So the tax incentives inside this structure are actually so valuable that the government, in their wisdom, has decided to limit when and how much you can contribute. So make sure you're aware of those caps. Check the age restrictions and the contribution caps before making your contributions. So now the boring stuff. Tax deductible or concessional contributions. Any contribution to super where someone's getting a tax benefit, they're called concessional contributions. So we've got caps in place, 27,500 for this year. Don't forget that that cap includes your super guarantee contributions. So if you're on a wage of 100,000, your employer or you have already paid 10%, 10,000 as SGC into your nominated fund. So your remaining cap will be 17,500. What we find is a lot of people don't realise in the past, salary sacrifice, that's how we did this. Now you can get to May, make a $10,000, $17,000 personal contribution to super and claim that deduction on your personal tax return. What you do have to remember though, is you must complete the notice of intention to claim a deduction form when you make this personal contribution. Do it at the time you make the contribution so you don't forget, because the whole strategy falls over without that form. Then if you picture your tax return, you put your $500 donation in. This year, you also potentially have a deduction for $10,000 because you've transferred that into super. Make sure what you need to remember is that the super fund, when they receive that concessional contribution, they'll withhold 15% tax on it. So you must make sure your marginal tax rate is higher than that. When you take into account the tax-free, the thresholds, the tax-free threshold this year is actually around the $25,000 mark. So don't take your taxable income below this mark, or it's not as tax effective. So let me give you an example. If you're on a wage of 100,000, $10,000 has already been made to super. You make a $17,500 contribution to super, 32% tax rate. That could be a saving of around $3,000. Again, all you've had to do is move money into super. If you're a high income earner, $250,000 mark, take care. There's a Div 293 law that will make the additional money over and above that 250,000 will have another 15% tax penalty. So just do your homework before making these contributions, but by all means do them. It's a great tax deduction at end of year. Unused concessional contributions. Our previous government came up with a great initiative. 2018, 1st July 2018, if you haven't used some of your caps in the prior, in this case, 4 years, you can bring them forward to this year. So in our previous example, you may have 4 times 17,500 available to you to use this year. Great opportunity if you've had an absolutely cracker year for some reason. If you've sold an asset and you've got a capital gain, why not offset some of that with, you know, up to $50,000, $100,000 deduction from super is an amazing saving. In order to bring forward those concessional caps, though, you must have a super balance in the prior year of under 500,000. So this initiative is on a 5-year rolling basis. So it's essentially a use it or lose it initiative. So if you look up your total super balance today and you're at 490,000, next year you will unlikely be able to use this unused concessional contribution. So use it now. Talk to your accountant, work out what your super balance is. If you are just under 500,000, you'd be crazy not to be doing it this year. Importantly, your contribution must be received by the super fund by 30 June. Sometimes there can be a delay, so I suggest you get onto it right now. Okay, a couple of boring ones. Spouse contributions not boring. If you've got a wife at home, she's not working at the moment, or she works part-time. If your spouse is earning less than $37,000, contribute $3,000 into their super fund and instant tax offset of $540. And you're levelling up your super balances for the future. If your spouse is earning between $37,000 and $40,000, there's still an opportunity for an offset, it's just reduced. And the one that's been around for many years and everybody knows about, co-contributions. So if you're under 71 years of age, earning less than $41,000, importantly, you must have some employment income, however. Personal contribution to super of $1,000, government gives you $500. Again, between 41 and 56 is still an eligibility, the co-contributions just reduced. And now for the more senior of us that are listening to this right now, if you are between 60 and 65 years of age, investigate the pension option inside your super fund. What this does is if you don't have the money to be making those $27,000, dollars of contribution this year, you can put the money into super, pull it back out on the pension side tax-free. An amazing strategy. Look into it and make sure you're taking advantage of it. When you are in an industry fund and you're considering, I'm in accumulation phase, what's this income choice structure that they're talking about? Once the fund is in pension phase, there's zero tax on earnings and capital gains. So what you should find is if you're balanced in accumulation phase and you look at, for example, Hester's income choice option, the earning rate on the income choice should be higher because that pool of assets is not paying 15% tax. So if your mum and dad are in that age group, have a look, make sure you take advantage of the tax effectiveness of superannuation. Thank you.
Well, thanks very much, Tanya. And, I should disclose to everyone that I sleep very well at night because I have your organisation and your professionals looking after all of this for my family. And it is incredibly technical. And I know receiving from you the sort of action plan list, the checklist. In the past, we'd been caught out with not having the money actually hit the superannuation fund account in the statement before June 30th. And I can't emphasize the importance to everyone of, sitting down with their accountant in particular and working through this stuff as soon as possible. Because unfortunately, I don't know whether you've tried to get a passport recently, but any number of larger organizations are actually having trouble dealing with lots of demand happening at the last minute. And superannuation funds are a classic. And the sooner you get organised and give yourself enough lead time to ensure that, you know, you do maximise the opportunities to save tax here appropriately, that you do so. It's very complicated. And so Tanya, you know, to you and your firm, thank you for the great work you do, you know, for us, and also for, you know, the special savings offer that you've got for any of our Business Advantage members who just want to have a bit of a super health check, you know, get a second opinion on things so that they just ensure that whether it's tax structures for the business, particularly with the change of government and other things that could be changing, all the way through to getting super right based on these very complex rules. Yeah, it's very well worth having a look at.
Just to kind of get us started, I'll introduce myself, our business, and kind of what we do as well. So my name's Lachlan Catanese. I'm the co-founder and director of Grant Help. Essentially, we're just a government grant consultancy that helps businesses educate around various government grant programs that they may not have been aware of. We help you guys apply and kind of help you guys roadmap on the best way to acquire various amounts of government funding that is offered not only at a federal level, but at a state level. In terms of kind of what we'll be talking about today, what is quite time sensitive and is also quite widespread in terms of eligibility for businesses is the Boosting Apprenticeship Commencement Program that closes in the next 15 days at the end of the month. Something to note just before we get started is if you see the word apprenticeship, it's something I want to kind of unpack a little bit more, as we've found personally with a lot of the businesses that we're dealing with is that the word apprentice has essentially given the wrong perception of what the program's looking for, and has actually made a lot of businesses, you know, if it be white collar or blue collar, actually not look into the program. So the word apprentice under the scheme is looking to upskill an individual in a current or a new job role where they haven't been previously skilled before, or in other words, they don't hold a very high qualification, or they hold a qualification in a completely different skill set. So essentially what the apprentice that we're looking to help with is they're actually looking to upskill apprentices that don't have previous qualifications or skill sets in their current job role. And that's what actually defines an apprentice. So what the scheme does in terms of an eligibility component, if any of you guys have hired an individual in the last 3 months on a full-time basis, or in the last 12 months on a part-time basis, or are looking to transition individuals from a casual to a part-time or full-time position today, and you're looking to upskill that individual in a certificate 3 or higher in administration, it could be Cert 3 business in terms of customer engagement, it could be more hands-on skill sets such as coding, painting. Anyone that's offering a certificate 3 would be covered under the program. And if you actually upskill that trainee, which is their new skill set in their new role, you guys could be looking at up to $28,000 worth of savings on their outgoings over the next 12 months, which is capped at a $56,000 net benefit. So it's 50% of their savings as a maximum, and it's a 50% subsidy of their actual salary. And it's broken up into 4 quarters. So essentially what the program's looking to do is upskill, retain new employees that fall into that eligibility of 3 months full-time, 12 months part-time. And then essentially if those individuals are looking to be upskilled and they fall into the category of eligibility, well, businesses can access 50% of their salaries over 4 quarters with a maximum net benefit of the employer of $7,000 per quarter, which is $14,000 in total kind of revenue earned by or salary acquired from the individual. Essentially what Grant Help's doing is we've done deals with about 10 to 12 registered training organizations offering virtual, which is Zoom-based learning in a COVID environment, which actually can range from anywhere from 1 to 3 hours of contact hours per week for the individual to kind of go on and all self-paced study and then essentially be upskilled on the job essentially, it's really important that the employer dedicates some sort of time for the upskilling, as the employer is the one that's receiving quite a generous reimbursement on their individual trainee. So we've done a fair few of these in the last 6 months, and we're really looking forward to finishing strong in the next 15 days with the program. Another part of our business, which is probably what we're most notable for, guys, is a program called the Export Market Development Grant. What the program does is it provides a 50% reimbursement on eligible international marketing related expenses, offering a dollar for dollar contribution or a 50% reimbursement on activities that are marketing your Australian product or service. So it must be either Australian product or service. Personally, at Grant Help, about 70 to 80% of our clients are actually all service-based businesses. So businesses that are doing consulting, offering technology, potentially education, selling courses, and then we also do have physical product businesses, but just letting you guys know, a lot of people overlook service-based businesses, and they actually make up majority of Grant Help clients, and they make up around 65% of the program clients. This one here has recently been changed for the first time in 47 years, where it used to be a retrospective scheme, where essentially you'd spend X amount of dollars, you engaged a consultant like us, we reviewed your expenses, your books, and then we could kind of help you guys determine a reimbursement. Now the coin has been flipped, and essentially what they're looking to do now is they're looking to provide an upfront certainty scheme. So essentially what that means, it's broken up into 3 tiers. So what you're looking to do is you're looking to kind of create a marketing plan or a plan to market or a strategy that follows the skeleton of the EMDG guidelines. And then you're looking to kind of present your case to the government, which is Austrade, which is the governing body, in kind of showing where they're going to spend or where you're going to be spending your future international marketing expenses. And it's broken up into 3 tiers. So the first tier is that tier 1 business, which is new to export, where businesses can actually receive up to $15,000 in upfront certainty prior to actually spending the money to go and essentially enter brand new markets. In terms of the markets that you can't enter, it's New Zealand, South Korea, and North Korea. Pardon me, it's not South Korea, North Korea. Sorry, my phone was just ringing. In terms of tier 2, that's actually the tier 2 is expanding already in any market that you're already currently in, which is around $24,600 based off last year's applications. Essentially expanding into a current market that you're in is essentially, doing new or traditional kind of marketing methods that you're already honing in on in that market. And that's a 3-year contract. And tier 3, which is the largest type of contract on offer at the moment, is $36,600. And that's for eligible Australian exporters that are doing a strategic shift. So either entering a new market, promoting a new product offering in a new or a similar market that they're already in, or targeting a brand new segment of the market as well. In terms of eligible expenses that can be used for international marketing, we're honing in on 6 expense types here. So promotional advertising and literature is an expense type where maybe, as Bill said, that you are building a global website that does have a cross-pollination between the domestic and the international markets. And essentially you could claim for the international component of that website. We also find, in terms of promotional advertising and literature, a lot of Facebook, Google spend, SEO, AdWords, and it's a really great way to essentially write off some of those costs that are directly marketing to the world. As if you're receiving a 50% reimbursement on those ad spends, well, you can really factor that into your ROI, which will essentially bolster it as well, and mitigating the risks. Another one that we see for maybe like more middle tier to larger businesses is overseas representation. So businesses, deploying people in their market or country of choice to directly sell whatever the product or service may be, and they can receive 50% reimbursement up to a certain ceiling. In terms of marketing consultants is an eligible marketing EMDG expense, as that can also be both domestic and international. So you can be leaning on expertise of domestic-based or Australian-based service providers to help you with a strategy, to help you with market research, to help you with consulting in your market of choice. And they can be both based here in Australia or international. And that also includes like PR firms, marketing firms, etc. A really common one, of course, pre-COVID and now entering this kind of post-COVID world is marketing visits for international development or drumming up some business and doing a bit of market research. So you can actually enter and go on these international trips to explore and better understand or market your product or service internationally. Number 5 is free samples, is providing $0 invoices or cost-based samples to potential or prospective buyers or sellers. And then number 6 is intellectual property, so registering patents, trademarks in international markets, and that does not include anywhere in Australia or New Zealand or North Korea, and there can't be any cross-pollination between the Australian and international markets. So with patents and trademarks, it must be in those eligible countries. In terms of the research and development tax incentive, this is quite a long-standing government grant that has been around for a period of time. Essentially, what the R&D is looking to do, it's a little bit more intricate in terms of an eligible applicant. So essentially, the best way to put it is the R&D is an incentive that is looking to support innovation and research and development for Australian service or product providers. Essentially, what they're looking to understand is that individual that is bridging a gap of knowledge. So they must be kind of undertaking like a hypothesis in a way that, we're seeking to do X and we don't actually know how to get to that end commercial outcome. And the R&D grant kind of supports everything in the middle in terms of, the R&D, the bottlenecks, the failures, and so forth. And the R&D essentially runs from the 1st of July 2022 to the 30th of June 2023. You can see there's 2 tiers in terms of your reimbursement. For businesses that are trading in a profit and that are less than $20 million, you're looking at a 13.5% rebate based on your tax. So let's say you had 100K worth of eligible R&D costs that can be made up of Australian labour, C-suite managers, marketing consultants, anyone that's actually attributing to the core activity of R&D. You can be looking at a 13.5% back. Let's say we're able to identify 100K, you'd be looking at $13,500 back. However, if you were doing a very similar R&D project, just for the hypothesis here, hypothetically, let's say you had $1 million worth of eligible R&D and you were trading in a loss come the financial year, you'd be looking at a 43.5% cash rebate back, which you're actually not paying tax on as well, which would be $435,000 back in your pocket. So there's really significant reimbursement differences based on if you're trading in a profit or a loss. And as the slide says, all expenses must be Aussie based. So you can't be looking at external consultants internationally. We once had a client that was doing drug research, and they were leaning on a lab in the Netherlands, and it took us 6 months to be able to get that one approved, as we had to show that this R&D and expertise and knowledge wasn't able we weren't able to carry that out in Australia. So it's really important to kind of make sure that all R&D is included here. And in terms of eligible expenses, labour is one of the biggest components that make up quite a significant R&D grant, whereas the EMDG, you can't actually include your marketing internal labour, whereas the R&D, you can include your operations domestically. You've got equipment, depreciation of assets, rent, a combination of general maintenance, and then anything that's involved with the actual prototyping, so like the core activity. And a really great grant we once did was with an EV or electric vehicle based business, and each prototype that they'd ever done with their electric vehicle were able to claim, which really made for a larger reimbursement. And that's why it's really important to have a professional look at the R&D, because you can really maximize your reimbursements, but by just being an expert in the field, by looking at the particular expense types that you can leverage and maximize your claim for.
Thanks a lot for that, Lockie. And there's a couple of questions that come through that I'll get you to answer shortly.
Of course.
I know from my own experience over the years where, our businesses have been involved, in international expansion, like licensing programs, software that we've put together internationally, that the Export Market Development Grant, as it was back then, was incredibly helpful. But what is important, and I think it's great that they've changed it now that you can sort of in advance, so you're thinking about now exporting. And I'd encourage everybody, unless you've physically got to have the customer, right there in front of you to deliver the product and service, if maybe they fly in, so international health related services where people are flying in, the marketing to bring those customers in may well be applicable, but everyone should be thinking about where are the customers overseas that I can be marketing my existing products and services to. And then in the way you do your accounting and set up your chart of accounts, it'll be much easier to set it up in the appropriate way at the beginning. So in terms of the time and effort required to make the application and then access the money will be minimized. So that's one thing to keep in mind with that. Another one, again, with R&D, if there's ever any time that you're coming up with a new way of doing something in the business, it may not necessarily be a new product, but let's say you're hiring a programmer to combine a couple of databases that you've got, or to automate some spreadsheets in a smarter way, it's worth talking to people like Lockie and his team to see whether that will meet the eligibility requirements for research and development. Particularly if you're hiring an external consultant or expert in a particular area, or someone starting to do a bit of applied research, say from a university, you'll be surprised how often a number of those things will actually be eligible. And then again, getting the accounting set up so that you track the expenses in a separate sort of budget and project plan will make it much easier to apply for, and to the extent that there might be an audit down the track, much easier then to justify how you've put that together. But Lockie, one question that's come through around the apprenticeship, traineeship wage subsidy is around its applicability to existing employees versus like a new employee about to be hired. Could you just expand on the sort of definitions and periods around, how someone becomes a trainee or apprentice? I thought it used to be something like as long as you've got them in the training program within 3 months of them starting work if they were full-time, or 12 months if they were part-time. But could you just provide us a little bit more contextual information on that, please?
Yeah, so based on that, in terms of the eligibility for the wage subsidy program to be able to successfully upskill the trainee and then be able to then have them be applied for the 50% wage subsidy, that employee, if we're talking from a full-time contract basis, must have only been with the business from 3 months from today. So essentially, it's got to be 3 months from today, their start day, or their first payment day. Would it make that particular trainee eligible in the business? That can be an existing staff member if they've been there for 2 months, because they would still fall into that 3-month category. And if they were to join the business today on a full-time basis, well, they're well and truly in front of that 3-month kind of window, making them eligible. So for that existing staff member from a full-time component, it's got to be within the 3 months since hired. So that's existing. And then if we're looking at existing part-time staff members, if individuals have been with the business for less than 12 months, let's say we've been there for, this time last year in July, so we've still got a month kind of up our sleeve, they would still be eligible for the program because they sit within, they've been with the business for about 11 months, which is before the 12-month expiry there for the part-time employee, which would make them eligible. So 3 months from the start date of full-time, of point of wanting to make them a trainee, and then 12 months if the part-time employee is seeking to become a trainee. And the last eligibility component there that I really want to touch on is if individuals have been with the business on a casual basis and they're transitioning off to part-time to full-time today, and that casual employee hasn't been with the business more than 12 months, well, they could technically become a part-time or a full-time employee today, which would allow them to be upskilled and eligible for the 50% wage subsidy. I hope that answers your question.
Look, thanks, Lockie. And I think, in our own experience, we've helped 300 members of Small Business Australia in the last 12 months access about $18 million of that wage subsidy. So we've got some educational videos around, and they're available on the Small Business Australia website under traineeships, because many of these businesses were wanting to put people into the office or work in different areas. They weren't trades-based apprentices. But I would encourage you with all of this to, drop Lockie's team an email. So there's a short-term opportunity given the June 30, but there are different programs available post June 30. And with the change of federal government and the review of the federal budget, there's going to be a new federal budget coming out in October. These things will be further changed. So we expect to see ongoing incentives of various sorts to hire people and train people in various areas, and it is always changing. And then at a state level, various states will have various incentives, grants available in this area as well. And then more generally, depending on the industry that you're in, the location, if you're in regional Victoria versus in Melbourne, as an example, there are some different grants available for regional-based businesses for various elements of potential R&D or market expansion. So, billions and billions and billions of dollars are distributed annually by the federal government, state governments, and local governments to support the starting, the development, the innovation, and the operation of small businesses. If you're like me and you get to the average government website, it's quite overwhelming. It doesn't really answer the questions. Getting some, external expert help on this is definitely the way to go.
And just on that note as well, and you can kind of see how our business is focused, where you've got, the R&D component if you're developing a brand new product or service or a tailored iteration to whatever your process may be for your business, which I think Bill just touched on. It can be that iteration that is, completely unique to your business as well. And then if you look at the development side of things, then you've got EMDG being, yes, more of that global market, but it kind of subsidized some of those, more kind of capital or, costs such as the website or the development of the branding that can be applied internationally, which is a subsidy for your marketing. And then the other, arm of the business at the moment is, the labor component, which is really kind of like three of the biggest expense types that we find and see in a business. And that's kind of why we've tailored our business to try and at least, serve each of those the best we can for our clients. Yeah.
So I've got a question here, Lockie, from Jackie, and it's around EMDG.
Of course.
Let's say that you've got a business that's selling products to Australian companies that have operations overseas, but the head office of the company is in Australia. Would that potentially qualify as, export market development expenditure if you're investing money in, research, marketing and sales, et cetera, to, promote the products to be bought by subsidiary companies of an Australian-based head office company?
So just from my understanding is that you're got the product offering and you're promoting them and selling them to other Australian businesses that are then taking them internationally. Is that correct?
I think the way I'm interpreting this, Jackie, is let's say it's BHP, right? Headquartered here in Melbourne on the Australian Stock Exchange, but it has separate companies in Chile, UK, Africa, and we're promoting, products to the African company that's owned by BHP. So it will be a separate legal structure. So it is an international business that's incorporated in South Africa, owned by BHP here in Australia.
Okay, so it's a subsidiary of a much larger business.
Which is Australian headquartered.
Yep. So essentially how the EMDG works, and I'm not sure where you sit, Jackie, with this, but is for you to be the applicant, right, of an EMDG claim, is that, Jackie, your business, even if you bought it from another Australian provider, is becoming the applicant or the principal owner of that product or service. And Jackie, you need to be the one that's directly spending money to market that product or Australian service to the end consumer. And that's what's really important, is that you need to be taking the risk by spending the money to essentially market it internationally. So essentially what we see a lot of the time is like, I don't own Paw Paw or A2 milk, and I might be able to buy A2 milk and Paw Paw from another Australian retailer or distributor. However, because I own that Paw Paw and A2 milk, I've actually paid for it, and then I've gone to market it internationally in China, as because I'm essentially marketing those two products to the end consumer, I'm essentially taking the risk as the applicant and the owner of the product or service in marketing it and growing it. And as a result, you would be rewarded. I hope that answers your question.
Yeah, look, I think the best thing is to organise a direct conversation with you to clarify, am I doing marketing to a procurement office sitting in South Africa, which is in a South African BHP proprietary limited, right? But it is owned by BHP Australia, but I'm not selling it to the procurement officer in Melbourne at BHP, who then buys it and ships it over to their subsidiary in South Africa. But look, I think it's best to have a conversation with you guys, Lockie, on that one.
Yep.
Now, I've got some other ones here for you. Can you claim R&D expenses already spent or realised prior to July 2022?
Great question. So essentially how the R&D works is it always works retrospectively with the financial year prior. So at the moment, post 30th of June 2022, we'll be looking retrospectively on all eligible R&D activities incurred from the 1st of July 2021 to the 30th of June 2022.
Yep.
So currently we're still in the claimable period of time, or for the next 15 days. So if you decide to spend X amount of thousand or whatever you're doing between now and financial year, that will conclude on the 30th of June, and then we'll be looking to then claim back retrospectively on the current financial year that we're in. And it's very similar in terms of how most grants work from a reimbursement. You're always looking at the financial year that's just passed.
Okay, thank you, Lockie. Now, Mark's got a question here. What's he need to put in place for his business for expenditure that they're expecting to spend in the next financial year, so 1st of July 2022, concerning EMDG, and R&D, so that they've got plans to be spending money that they want to claim back on EMD or get some of it back from EMDG, Export Market Development, and for other part of it on the R&D grant. What's his business need to start getting in place now?
Okay, so there's two parts to this question because they're both separate beasts. In terms of EMDG, it's really easier to answer. So essentially, you understand what you're looking to do internationally or where you're looking to grow, I assume, as a business owner. So firstly, you need to understand, do we have an Australian service or an Australian product is the first, tick box. With that being said, is then, where are we looking to spend money? If we're new to export, we've got up to $30,000 to spend and we're going to get 15K of that back. Where can we best allocate that? Where are we going to get the best return on investment? If we're new to export, and what costs are we wanting to write off? What are your biggest pain points? Is it IP and patents and trademarks? Is it marketing or getting a sales rep? Or is it building the website out? Or even providing free samples? And that's something that's really subjective to you and your business. So identifying what things would we love to be able to write off, number one, and what's going to provide the best return on investment or the safest path forward would be the first question. or answer for the EMDG, and then sitting down with someone like us and we map it out. So what we do is we provide tailored marketing plans that play to the strings of Austrade to really kind of hone in on those legislative points, just to make sure that we are in line with what Austrade are looking for. But yeah, my recommendation there is understanding where you're looking to spend money and when, and then we figure out a relevant tier based off the expenses that you're looking to potentially apply for. Part 2 of the question is R&D. So R&D, in terms of planning for the R&D, in terms of you being able to get that money into liquid cash is going to be a little bit longer, because if you've done no R&D activities in the financial year 1st of July 2021 to the 30th of June 2022, and you're looking to undertake R&D in the 22-23 financial year, your first reimbursement is actually going to be on the 1st of July possible, that you can retain the cash with the 1st of July 2023. So what I would be recommending from that point of view is, firstly, are you undertaking R&D or eligible R&D? Secondly, let's put some reporting in place, such as, which salaries are attributed to the R&D. Is Bill and Locke, the technical lead on, whatever you're looking to create, and how many hours are actually attributing of their salary to the R&D? So it might be 50%, 80%, or 100%. And then from there, you're kind of getting all the reporting ready, which is really fundamentally important. If there is an audit, we see around 5% of our claims to receive an audit, which is very low. However, they can swoop back, and you just want to make sure all your bases are covered as well. So reporting in terms of the R&D, the salaries that are actually attributed to the R&D, understanding what your strategic direction is in terms of how much of your, thinking and implementation and strategic lead is associated with the R&D, and then any other supporting costs such as materials, prototyping, et cetera, but it would be the reporting aspect that you'd want to be looking at for next year if you've spent nothing in this current financial year.
Right, great, Lockie. Now we've got a couple of requests for people's contact